What if I told you that in 2026, thousands of Australian retirees could be receiving up to $1,178 per fortnight under the age pension? But many still don't fully understand how that number is calculated, who qualifies for the full rate, and who could see their payment reduced. If you're relying on the pension now or planning to apply soon, what you don't know could cost you hundreds of dollars every fortnight. And in today's economic climate, that's not a small amount. Welcome back to Centrelink Compass AU, the channel where we break down complex Centrelink rules into simple, practical information you can actually use. Today we're diving deep into Australia age pension rates 2026 and explaining exactly how the $1,178 per fortnight payment works, who gets it, how it's calculated, and what could affect your entitlement. Let's start with the big number everyone is talking about. In 2026, the maximum full age pension rate for a single person can reach approximately $1,178 per fortnight when you combine the base pension, the pension supplement, and the energy supplement. But that figure isn't automatic. It's the maximum payable rate. To receive it, you must meet strict eligibility criteria under Services Australia and Centrelink rules. The age pension in Australia is means tested. That means your income and your assets are both assessed. Whichever test results in the lower payment is the one that applies to you. Many retirees are surprised to learn that even small changes in bank balances, superannuation income streams, or part-time earnings can reduce their pension. First, let's talk about age eligibility. To qualify for the age pension in 2026, you must be at least 67 years old. That age requirement has now fully transitioned. There are no further scheduled increases at the time of this update, but eligibility doesn't stop at age. Residency rules also apply. Generally, you must have been an Australian resident for at least 10 years, with at least 5 of those years in one continuous period. Now let's break down the $1,178 figure more clearly. The age pension payment is made up of 3 main components. The base rate is the core payment. On top of that is the pension supplement, which helps with utilities, phone bills, and other living expenses. Then there is the energy supplement, a smaller additional amount that continues to be paid to eligible recipients. When combined, these amounts bring the maximum single rate close to $1,178 per fortnight in 2026. Couples receive a different rate. For couples, the payment is calculated per person and is generally lower than the single rate per individual, but higher when combined as a household total. Now let's move to the income test. Under the income test, you can earn up to a certain amount before your pension starts to reduce. For singles, there is a free area. Income above that threshold reduces your pension by 50 cents for every dollar over the limit. For couples, the combined income is assessed and reduces at a different threshold. This is where many Australians lose part of their entitlement without realizing it. Bank interest, superannuation income streams, rental income, and even some overseas pensions are counted. Deeming rules apply to financial assets, meaning the government assumes your savings earn a set rate of income, even if your actual interest rate is lower. Next comes the assets test. This includes your bank savings, investments, superannuation if you are over age pension age, vehicles, caravans, boats, and investment properties. The family home is generally exempt, which is a huge advantage for homeowners. However, the moment you downsize or move money into assessable assets, your pension calculation can change dramatically. For homeowners, there is a lower asset threshold compared to non-homeowners. If your assets exceed the threshold, your pension reduces by a set amount per $1,000 over the limit. Once you pass the upper cutoff limit, your age pension entitlement drops to zero. This is why some retirees with modest super balances receive the full $1,178 per fortnight, while others with slightly higher savings receive only a part pension or none at all. Indexation is another important factor. Age pension rates are reviewed twice a year, typically in March and September. The increases are linked to inflation and wage measures to help maintain purchasing power. With cost of living pressures continuing in 2026, these adjustments are critical for retirees on fixed incomes. But here's something many people overlook. Even if you don't qualify for the full $1,178, receiving even $1 of age pension can unlock access to the Pensioner Concession Card. That card provides discounts on medications under the Pharmaceutical Benefit Scheme, reduced utility bills, council rate rebates, and public transport concessions depending on your state. Speaking of states, while the age pension is federally managed, additional concessions vary across Australia. Whether you live in New South Wales, Victoria, Queensland, Western Australia, South Australia, Tasmania, the ACT, or the Northern Territory, your state government may offer additional support. Another key strategy retirees use is managing assessable assets carefully. For example, funeral bonds within allowable limits may be exempt. Gifting rules allow limited asset transfers each financial year, but exceeding those limits can still count against you for 5 years. These are not loopholes. They are structured rules, and understanding them can protect your eligibility. Superannuation plays a major role in 2026 retirement planning. Once you reach age pension age, your super accumulation account becomes assessable under the assets test, even if you're not drawing from it. If you convert it to an income stream, the income test will also apply under deeming rules. Many Australians assume that paying off their mortgage or renovating their home won't affect their pension. In many cases, improving your principal residence does not count toward assessable assets. However, withdrawing large sums and holding them in cash temporarily can impact your assessment if not timed correctly. Now let's address part-rate pensioners. If your income or assets exceed the full pension threshold but remain under the cutoff limits, you may still qualify for a reduced payment. This is extremely common. A part pension combined with modest super drawdowns can sometimes create a stronger overall retirement income strategy than relying on super alone. It's also important to understand that reporting obligations matter. If your financial situation changes, you must notify Centrelink. Failing to report increases in income or assets can lead to overpayments, debts, and potential penalties. For couples, relationship status is crucial. Living arrangements can affect your assessed rate. Even if one partner is younger than age pension age, your assets and income may still be combined for assessment purposes once one partner applies. There is also the work bonus scheme. This allows age pension recipients to earn additional employment income without immediately reducing their pension. A portion of work income is excluded under this scheme, encouraging seniors who want to remain in the workforce part-time. Let's talk about inflation. Groceries, rent, electricity, insurance premiums, all of these have increased significantly over recent years. While the $1,178 per fortnight may sound substantial, real purchasing power depends on economic conditions. That's why understanding every dollar of entitlement matters. Some retirees also qualify for rent assistance if they pay private rent and meet eligibility requirements. This is paid on top of the age pension and can significantly increase fortnightly support. If you're approaching age pension age, it's wise to apply early. Claims can be lodged online through your MyGov account linked to Centrelink. Processing times vary, so applying in advance of your 67th birthday is often recommended. Financial advice can also play a role. Understanding how to structure super drawdowns, asset allocation, and income streams in line with pension rules can make a difference over decades of retirement. The key takeaway is this: the $1,178 per fortnight is the maximum rate, not the automatic rate. Your personal circumstances determine what you receive. Income, assets, relationship status, residency history, and even timing can influence the final figure. For many Australians, the age pension remains the foundation of retirement income. Even those with superannuation often rely on the pension as a safety net when markets fluctuate. Planning ahead is not about exploiting the system, it's about understanding it. The rules are detailed, but they are transparent. When you know how they work, you can make informed decisions instead of reacting too late. If you're already receiving the pension, review your circumstances regularly. If you're nearing eligibility, start preparing documents now. Identification, residency records, bank statements, super details. Having everything ready can reduce delays. Australia's retirement system combines compulsory superannuation with the age pension to create a balanced support structure. But navigating it requires awareness.
The difference between a full pension and a part pension can be hundreds of dollars per fortnight. Over a year, that's thousands. Over a 20-year retirement, it's life-changing. So ask yourself, do you fully understand how your payment is calculated? Are you confident you're receiving your correct entitlement? Or could a small oversight be reducing your support? At Centrelink Compass AU, our goal is simple: to make sure you're informed, confident, and prepared. Because retirement should be about stability, not uncertainty. If you found this breakdown helpful, make sure you subscribe to Centrelink Compass AU for regular updates on pension changes, Centrelink rules, superannuation developments, and cost of living support measures affecting Australians in 2026 and beyond. Share this video with anyone approaching retirement age. The more people understand the system, the better prepared they'll be. Drop a comment below if you'd like a detailed video on income test thresholds, asset cutoff limits, or strategies to protect your pension eligibility. Your questions help shape future content. Thank you for watching Centrelink Compass AU. Stay informed, stay prepared, and I'll see you in the next update.